is LA ever going to have that 20-year period that it's had from the 90s to 2020?
In general, I'm bullish on California, and I'm bullish on Southern California. We've done probably 500 assets, $8 billion of real estate, 8 countries.
We're in a housing market now unlike any other.
2/3 rent. Most of them are renters by necessity. They're completely priced out of being able to own homes, and the answer is we need to build more houses.
Welcome to No Vacancy, where I share conversations with LA's top multifamily owners, investors, and visionaries. I'm your host, Taylor Avakian, the founder of the Group CRE, and I specialize in the sale of apartment buildings in Los Angeles. On this show, we cut straight to what matters, market insights and real-world strategies straight from LA's multifamily icons to help you navigate one of the most complex real estate markets in the world, Southern California. Enjoy. Today's guest is Fred Gortner. Fred, thank you for being here. What I'd love to know, Fred, is why are you sitting in this chair today?
Well, because you're a good friend and you're a pro in the market, and my whole business revolves around guys like you. So
I appreciate it.
And you asked me.
I did. I was very persistent, I would say, but you were pretty easy. You were down for this, so I appreciate you for doing that.
I love doing these things, and you know, I could talk forever about the business. So
give me so. I wrote down some questions from ChatGPT because it's so good at what it does. First one I think is a good place to start.
Our nickname for that is Chad, by the way.
Chad.
Anytime we need to have something done, well, let's see what Chad can do.
Let's see what Chad does. Honestly, I love it. I use that thing every day. Are you guys implementing AI in your
No,
systems?
I've only used it once. I want to.
Yeah.
I'm dying to.
Yeah.
I used it once to write a job description for a VP of asset management, and it did 90% of it was great.
Wow.
In 5 seconds.
Yeah.
I just had to tweak a little bit of it.
Totally.
I think it could be not game changing, but if I could have a virtual assistant, if Chad could be my virtual assistant, that could be huge.
Right.
I haven't figured out how to do it yet. I think it's early stage. I'm sure people are going to come up with apps that will make it work for people like us.
Totally.
How about you? I mean, have you found a way to use it?
I'm obsessed with it, just because I have so many pain points in what I do in the brokerage business that anything that can speed up, because we're kind of like solo entrepreneurs, solopreneurs, right?
Yeah.
And so unless you have a big team and can afford to have 4, 5, 6, 7 employees, right? Like being able to be efficient with the marketing materials, the listing descriptions, the outreach, the follow-ups, all of that stuff.
That's what it should be doing.
Yeah.
And I don't think the capability's there yet.
Yeah.
But that's what you're envisioning the same thing I am.
Yeah, I'm pretty tied into it, Fred, and and I speak to some guys at the Blackstones and the Greystones and Grey Stars and all that stuff. The analytical ability for basically taking big data, crunching it in, and figuring out where opportunities are.
Yeah.
Right? Because real estate's one of the only businesses that there's still information asymmetry.
Yeah.
Like you can basically insider trade, quote unquote, if you know more than someone else. Yeah. Which is...
Well, and other people are going to do it, so you have to do it. And the question is how. To the extent... Right now, it's so obvious if content has been written by it.
Yeah.
And I've seen letters sent to me when we were interviewing for a VP of asset management position. I had a few thank you letters that were so clearly written by ChatGPT because they didn't say anything. Well, there's nothing of substance.
You need to be really good at prompting, or you need to take the 80% that it does and then add your flavor, add the human element, add some touch to it. It's only going to get the worse it's going to be.
But if it shouldn't be that way, and that's what I hear the guys who are using it. It's all about the prompts. And what I would love is if Chad could just shadow me for 6 months, look at what I do, how I do it, who I talk to, how I communicate, be looking at my emails, what are the applications that I use, and then 6 months in say, Fred, I got some suggestions for you, or let me handle this.
Right.
You know,
it'll get there.
I'm never. I mean, we're and you are too.
Yeah.
We're two white glove. We're a service business at the end of the day, and investors are, the service we're providing is exceptional investment performance, but communication, transparency, all that. Chad can't do that, you know, but if we can make our white glove service to our clients even higher notch, and if you can get the analysis, the analytics in there, that's huge. I haven't found that yet. I mean, I've tried to prompt in, okay, give me some market data on West Covina or whatever it is, and it's not there yet.
No, but there are companies that are spending an inordinate amount of time because of how big the commercial real estate space is, figuring out those specific problems. And I actually think that's where this AI goes, is these specific like use case models, and the way that humans interact with it is so specialized to that like it niches itself. And all the knowledge is based upon that niche.
If you figure out a good productivity, please share.
Yeah, no, I will.
Please share.
So just to give a little people, or the people, a little bit of color behind you. So Paladin Realty is what you...
This is our 30th year.
30th year.
Believe that.
So using a question from Chad, what inspired you to start Paladin? And how has your vision for the company evolved since its founding?
Well, it was actually the part of the genesis came out of the story I was telling you beforehand, which I'll just briefly do. I cut my teeth, and I graduated from college and spent 2 years in New York in banking, which was just great. You got to live in New York once in your life, and I was there from '86 to '88, which was just prime time, top of the market. Great time to be there.
I see some of those old videos of New York City back in its heyday, and I'm like, shit.
It was just such a great time to be there.
Big old boxy suits, really.
Yeah, oh yeah. No, dude, I
how many colored
I was
ties
decked
did
out.
You have, man?
I would, Brooks Brothers, decked out, and and we were being paid well. There was a lot of young people there, and it was just a great time to be there. But it was also it was the '80s version of kind of free money. We were making stupid loans in hindsight. I won't name the organization, but it was just the market.
Wasn't it the savings and loan crisis?
This predated that. Okay. So this was '86 to '88, and I remember one, and my clients were principally movie producers and real estate developers, and I remember one loan, a developer comes in, and we basically. He wanted 110% financing, so he wanted us to pay for the construction and cash out, commit to it up front, because here's what it's going to be worth at the end of the day. And more than once, our chief credit officer, this is the risk manager, approved it and said, well, if we don't do it, Manny Hanny will do it, or Chase will do it. And so I quickly realized, okay, I'm on the wrong side of the table here. This is, and so I came out to business school in '88, and the best thing that happened was my future wife sat down right behind me the very first day of business school, which is great, and pick them right the first time.
Right.
I've been married for 34 years.
Jeez, congratulations.
And but so I actually. I came out, I want to either be a movie producer or a real estate developer, which are essentially the same skill sets. Right?
Pretty much.
Exactly the same thing. I scored an amazing internship at an independent studio in Hollywood, and I lasted about 2.5 weeks because it was just this cutthroat, I just did not want to deal with the personalities of the entertainment business. At least, and the thing I like about real estate is, these are hard assets, and so much of it is common sense. And to the point you made earlier, and insider trading is legal, and how you can inform yourself on insider information really helps determine success. So I hatched a plan in the middle of business school with a good friend of mine who's still in fact, I'm having lunch with him today after this. His father was an orthodontist, but had invested in real estate, and it was being managed by a third-party property management company. And you drive by the assets; they just kind of look run down and tired. And Brent and I somehow convinced his dad to let us start a property management company around his family's real estate holdings. We didn't know anything, and here we are in our early 20s. Brent had been a runner at CBRE, so he knew a little bit about real estate.
How old were you?
I was, when was this? This was '89, so I was born in '64, so, I was creeping up on my mid-20s. But I didn't know anything. I mean, I was taking real estate courses at UCLA.
How many buildings?
And so you have about a dozen properties.
So you had to take on a dozen.
And so we took on a dozen. We created from scratch with like the original DOS version of Yardi, a property management company. We taught ourselves not only property management, we taught ourselves how the value-added business.
Yeah.
And one by one, we fixed up these things. And his dad kept a short leash on us, which was appropriate.
Yeah.
But we convinced him, look, we can upgrade this and add value. If you were a tenant in our properties, you had a leaky toilet at 2 a.m., you called a number. And it would, and we had beepers. A lot of your listeners won't know what that is. These are these predated phones. They're little buzzers, okay? And if that number would make the beeper buzz, and 1 week it was sitting on Brent's bedstand, and 1 week it was sitting on mine, and just back and forth. And it was trial by fire in the trenches, and that portfolio has been just the rock bed of that family. It's been an ATM machine for them. Brent continues to run the company we started, and it's been just it opened my eyes up. But I wasn't I didn't have any equity stake in the value we were creating. So I was kind of itching. My first child was on the way, and I was itching to get out there and be a principal and do something on my own. And I got introduced to former Treasury Secretary Bill Simon, who was he was Treasury Secretary back in the 70s, and he was really the pioneer of the leverage buyout business in the 80s, and he had amassed this fortune very quickly, and he had a pretty substantial real estate portfolio, but it was all accidental. And so my partner and I, Jim Worms, who was running Solomon Brothers at the time, created what is now Paladin Realty in partnership initially with the Simon family. And our deal with them is we will manage this sort of eclectic portfolio of real estate you own that had no it was really leftovers from leverage buyout. They'd buy a company and then they'd end up with a whole bunch of glass factories. They'd hold on to the real estate, but in the middle of nowhere, and there's no strategy behind it. So we said, as we monetize and improve the value of that, you provide sponsor capital so we can create a institutional business. And fast forward, 30 years later, we've done about $8 billion of real estate in 8 countries. We're a big home builder down in Latin America. We've developed nearly 40,000 housing units down there.
Jeez.
And we've done multifamily. It was actually the multifamily business started for us because the Simons had a portfolio of Simon and their partners had a portfolio of glass factories with a negative tax basis. And we said, let's sell that, roll that into 1031 into value-added apartments. And that started our value-added apartment business with a little bit of Core Plus on top of it. And 30 years later, we've done over $1 billion, substantially with them, but with other investors as well. About $750 million in value, over 20,000 units, over 100 assets all across the country.
Jeez.
And 3/4 of that was value-add. And of the value-add portion, half of those deals were here in LA just because this is where we live.
Yeah.
And the SoCal returns were off the charts. I mean, the whole portfolio did extraordinary. Of all the strategies that we've done across $8 billion of real estate, our U.S. BC workforce housing value-added apartment business has been by far the most successful.
So speaking of Los Angeles, because I had a conversation with an owner the other day, and we were talking about, is LA ever going to have that 20-year period that it's had from the 90s to 2020, basically 2022?
Yeah.
Do you think it's possible for the level of appreciation and rent growth in the previous 20 years to happen in SoCal and LA in the next 20 years?
So a lot of the success that you saw for investment was cap rate compression as a result of interest rates heading down to zero.
Yeah.
So a lot of stupid investments looked good, having nothing to do with the left side of the balance sheet and everything to do with various Fed policy. We are bullish I'm bullish on California in general, and I'm bullish on Southern California. And there are attributes in the about the SoCal market, and I speak from experience because we've invested all across the country. So I've active in Phoenix and Atlanta and Dallas and stuff. Real estate almost everywhere except for SoCal is all about market timing. That's 80% of the profit that you make in a deal was determined when you bought it, and what you bought, where, and when. And it's not that those factors aren't important in LA, but there are some attributes to this market that, in answering your question, I think give it long-term resiliency. And it probably has the most attractive supply-demand fundamentals of any market and any product type for Class B, C apartments here. It is unlike the rest of the nation where 2/3 of the households own their own homes. The opposite is true here. 2/3 rent. Most of them are renters by necessity. They're completely priced out of being able to own homes. And the only true affordable, naturally occurring affordable housing available to them are these older Class B and Class C apartment buildings. So you have this resiliency of demand that just defies cycles, number one, with a large permanent rental class that has no other choices near the schools and near the jobs, unless you want to schlep all the way out to the high desert or Inland Empire, and be in your car for 4 hours a day. The barriers to new supply in this market are notorious and need to be fixed. If that is the thing that we need to do nationwide and in California and in Southern California, we're 1 million units in this state behind where we need to be in terms of housing people. And that's why rents are high. The answer isn't rent control. The answer is we need to build more housing. It's just Econ 101. The rental housing stock here was built out in the decades after World War II, when it was just orange fields over here in the valley. And so land was cheap, it was plentiful. And so what they built were these low density, 2-story courtyard style apartment buildings, small. I think 90% of the rental housing stock here is 50 units or less, around a pool or a courtyard. You could never build these things today. They just wouldn't be feasible. And so, you've got a sea of these things, but they're priced off of today's income. They're not priced off of what the development potential is, because nobody's going to pay you for that with all the litigation.
It doesn't make sense.
Yeah. So the cost advantage relative to I just read that Santa Monica is building affordable housing, kind of take the homeless off the street and house them at $1 million a unit.
Yeah. Did you see that?
Unbelievable.
Crazy.
It's crazy. It's nuts. And our all-in cost basis is between $250 and $350 a unit. So we're at such a huge discount.
And that's for like really nice new apartments, right?
Yes.
BC, like your renter type for the apartments that you guys build and renovate and things are the middle America workers, right?
Yeah, these are working class, middle class, low and moderate income households.
Yeah.
And we typically gut when we get a vacancy, we gut the units.
Yeah.
And it's all new. It looks like a brand new apartment when you're in it. We do everything that we can to spruce up the exterior and improve the common areas and make it really feel contemporary.
Yeah.
There's not many amenities in these things. If we can add barbecue areas.
There's not much space to add amenities.
There's not that much space.
Because you're taking existing old 50s, 60s, 70s, 80s, 90s buildings, right?
Yeah.
And then renovating the existing. So tearing down walls if you need to, but sometimes just putting a paint coat, new flooring, new bathrooms, new all that stuff.
We're upgrading electrical and so forth. But what's really important to us is the end product needs to be affordable.
Yeah.
So we always try to be in the 30 to 40% of area and median household income in whatever we do, and that's one of the reasons, Taylor, why we have a really high percentage of transfers where an existing tenant stays at our property and voluntarily moves out of a shoddy, unrenovated unit into one of our renovated units, and we'll provide incentives to do that. So, it's kind of one of the fallacies of folks who look in, and particularly at some of the working class households, the assumption is, they just want to live in the cheapest place that they can find. No, they want what every family wants. I want a safe, well-maintained, professionally managed. I want to live in the best place that I can afford for my family. So affordability is a huge, huge issue for us. One of the reasons we love this market and why there's great value-added opportunity is there's very little institutional penetration in the BC space. All the institutional capital is either playing the periphery, like the Inland Empire, where they can get some scale, but you might as well be investing in Phoenix as far as I'm concerned. Or they're doing ground-up development, which is not for me. Yeah. Plenty of guys who do that. Yeah. So this is a mom-and-pop space. We have yet to buy an asset that has RUBS, which is the ratio utility billing system. That is how that's apartment management 101.
Which is crazy how apartment owners don't start, like, why that isn't something that's done regularly.
So, I think
is it a scale thing?
I'd say maybe half the assets we acquire, Taylor, are self-managed too. I met with a seller last night. Yeah. We asked for a great guy. I asked for financial statements, historical financial statements. They're handwritten. Okay, so this is, and this is actually one of the more sophisticated mom and pop folks that we've been buying from. This is 2024. Yeah. So that's the market here. Is it, and they manage them. What they want is steady cash flow. Yeah. And so they don't like a vacancy, because a vacancy means the bare minimum, I got to replace carpets and maybe patch this up. I'm putting $5,000, $7,500 into it. They don't want to do that. Yeah. So they deliberately keep rents low, and they don't want to put CapEx in unless they absolutely have to. Mm-hmm. And it's rational for them, particularly if you overlay. I mean, look at LA City. If you all these properties in LA City during COVID, operating expenses were going up by at least 10%. Mm-hmm. Insurance was going up by 20% a year. Payroll's going up. Inflation is hitting all the operating expenses. So my operating expenses we have one asset that's subject to City of LA RSO, went up by at least 50% in 3 years. What did the City of LA allow me to raise rents? Zero during that time frame. So my operating margin is getting squeezed. But that operating profit that net operating income doesn't go into my pocket. The vast majority of that is going into debt service. Mm-hmm. And the balance is going into upgrades. 100% of our cash flow during the first 3 or 4 years that we own an asset is either going to our lender or it's being reinvested in the property to upgrade it, the experience for the tenants and the value of the property. We barely were able to do that. We thankfully had budgeted extra equity. Mm-hmm. Had we couldn't rely on any cash flow from the property.
So you raised a little bit extra in the raise for that property to be able to
because we knew it was RSO and we knew that was our only way.
Yeah, it's speaking of RSO, and I think that is what we've talked about a little bit too, and why LA is so attractive from a sub-institutional space. But walk me through the misinformation on rent control. Like, why is there this big us against them, good, evil, bad?
So the advocate. So first of all, are there bad actors in our space? Absolutely, and they taint the whole industry. It's not a majority; it's a minority, but it gets publicized and so forth. So there's people that don't execute their business ethically. Paladin is huge on values. And affordability and executing our business ethically is like top of the list. Do the right thing. You asked my children. We had Gortner family values on our stovetop for 30 years. Wow. And you asked my kids, what's number one? It's integrity, do the right thing. Yeah. And that's not just for our investors. It's not just for the broker relationships that we have. It's the tenants that we have. So number one, there's some bad actors that give the industry a bad name. Number two, the affordable housing crisis is real. Mm-hmm. I mean, it is real. and housing prices have been going through the roof, and rents have been going through the roof. Why is that? It's, you know, you don't have to have taken Econ 101 to know that it is supply and demand. And we are 1 million units short in California. We are 400,000 units short in just LA County. Based on the amount of new construction that's happened recently, it'll take 20 years just for LA County to catch up on its current housing deficit, and that doesn't take into account, you know, depletions of supply and so forth. So the need to address the affordable housing crisis is real. And rent control is it's well-intentioned because the motivations behind it are real and need to be addressed. The problem is it is counterproductive, it's misguided, and it ignores just those principal supply and demand tenets of Econ 101. And it's a very blunt tool because it benefits rich kids as much as it does help renters in place. But what it also hinders is, let's say you have a rent-controlled apartment on the east side of Los Angeles, and you have this great job opportunity over here on the west side. You can't pursue that, or you're now faced with spending 4 hours in the car. Yeah. So there's a lot of disinformation. This whole notion that Blackstone controls the housing market in California is ridiculous. Yeah. I mean, the institutional-owned housing across the country and in California is under 5%. Wow. So it's such a small subset. This is a mom-and-pop market here. So these villains that they've come up with, I mean, it's not misinformation. It's disinformation to achieve a political aim, and I don't like that.
Yeah.
The right solution is, there's really two that I can think of.
Yeah.
Anything that you can do to encourage new housing is what ultimately is needed to solve this problem. The accessory dwelling unit law, actually, I think was some of the best policy to come out. Yeah, and it's been a huge impact.
Yeah,
and it's an impact that helps mom and pops, and it's an impact that helps the overall market. The second thing is, if you really want to help renters in need, then give them and you think that housing is a right, and the principles of that are hard to argue with. Rent control doesn't do that. Vouchers do. Expand the voucher program. Society should be paying for it because this is a societal benefit. It shouldn't be coming on the backs of mom and pops that are struggling just to pay the bills with their apartment buildings,
Yeah, no, for sure. It's interesting to see too, because it's kind of this, it feels like, because I sat in, or was part of the ULI Housing Council, and so we sat in on this new CHIP ordinance. This LA is coming out with a new mandated by the state, a new housing program, and in that, the goal of that is to spur more housing. We're 400,000 short. They understand that. They know that. Yeah. They're updating the TOC program. They're updating a bunch of different development standards, zoning, things like that, density bonuses, on menu, off menu incentives. And we were sitting down, and this is a room full of architects and attorneys and real estate people, developers themselves. And we were looking at this, and we're it's so confusing. You literally have to have a PhD in understanding development to make any sense of it as a normal human being. Yeah. And when you calculate the actual benefit from a development standpoint, right? Like, does this feasibly improve the ability to develop?
Yeah.
On the surface, okay, maybe you have some more density, but overall, it doesn't. We didn't feel like it moved the needle. There were so many. They added one thing and then took another thing away. That was a benefit.
Yeah.
We calculated the cost of construction, and it's like it still doesn't pencil for a new development. So what change is actually impacted?
Yeah.
So it feels like they're trying to. Yeah. They're like shuffling a bunch of things on the table and seeing, hey, we did something new. But in reality, I don't know that the developers that I speak to actually feel like it's improving
Yeah.
that ability.
Yeah.
Is there anything that we can actually do, or is it got to be a policy push? Does it have to be from the tenants? Where does the change need to come from?
Well, so Prop 33
man.
could be a disaster, because what Prop 33 does.
Yeah, can you explain Prop 33?
So back in 1995, some sensible policy came out of Sacramento, and a law called Costa-Hawkins was passed. And that's been the law of the land for the last 30 years. What that did is it outlawed some of the most draconian forms of rent control that that not only limited what you could raise rents on an existing tenant, which now there's rent control that limits that statewide.
Yeah.
AB 1482, which is really a moderate form, I think a balanced form of rent control, limits that. So people have visibility. They're not going to get priced out of their homes. But it limited, if you had a vacancy, it was limited on how much you could raise rent. It's called vacancy control.
Yeah.
So there's not only what incentive did a landlord have to try to upkeep these older properties, but they actually were having operating margins squeezed. I mean, operating expenses were growing, and yet rents at a faster rate than rents. And at some point, those lines start to intersect. And so this, it's so, again, Justice for Renters Act. The justice implies that you've got some nefarious, greedy corporate landlord. This is the disinformation. It's as bad as the ULA tax, which they called a mansion tax, the Paris Hilton tax. And one of the LA City Council members, she didn't think she was being recorded, admitted the bait and switch. They admitted that it was a deceptive advertising campaign. And, it means it applies 90% of that tax is coming from the sale of office buildings and so forth. And so all of a sudden that's ground to a halt. So what Prop 33 would do would repeal Costa-Hawkins. What Costa-Hawkins did was one of the most powerful things to incentivize new development, because developers knew, okay, I got a 15-year period where I'm going to be able to get the market rents
time to make the deal work.
To make an investment. And then after that, cities could put in place rent control. The state, AB 1482, I think was I would prefer no rent control.
Sure.
I do believe that letting the market work and incentivizing housing, having enough supply, is the best way to. That's ultimately what we need. We need more supply.
Yeah.
We have a 1 million unit shortage in the state of California. That's a bigger cause of homelessness.
Yeah.
It's not Blackstone's fault that we have homelessness in this state. It's NIMBY. It is all of the barriers to new construction that have put people out. There's obviously a lot of economic and other factors that contribute to it. So we'll see. I think that there's a pretty big education campaign, because this Prop 33 will come on the backs of small mom and pop landlords who are already scraping by.
Yeah. No, it's going to be interesting to see. We're in August of this year. The vote is going to be in November, so we will know eventually which way it goes. I think for New York,
talk to your neighbors.
Yeah,
it was disappointing that the California Democratic Party endorsed it. I don't think they really thought things through on it, to be perfectly honest. The true answer is targeted rent relief through vouchers to the families who truly need it. Let's expand that program, and then ultimately come up with other creative ways besides ADUs to be able to add more housing.
So that's actually a good segue. I'm curious to know your view, your contrarian view on the market, and where do most people disagree with you? Like where is your views different than the majority?
Well, so when people actually understand what we're doing and how and the conservative approach that we take, whether it's the use of debt, the discounts to replacement costs that we seek, and so forth. We never really get – everybody understands the thesis, and they're like, wow, that sounds great. Where I see any disagreement with what we're doing, it's the focus on California and Southern California in particular. There's a lot of people out there that are just bearish on the state, and you get high-profile, corporate companies exiting like Tesla and so forth to Texas or elsewhere. But even that's just headline noise to me. I mean, if California has been most heavily taxed and heavily regulated state in the nation for as long as I've been alive. And yet we've grown from being the 10th largest economy in the world to the 7th. We're now, if I remember correctly, the 5th largest economy in the world. Southern California, which is an extremely difficult place to do business, challenging place, but it is the 19th largest economy in the world. So despite all of the regulatory and tax and other pressures, this state is firing on all cylinders. Why is that? We have the best weather in the country. We have the best terrain, beautiful real estate in the country. We have some of the best universities in the country. If you are going to start it, we are the innovation capital of the world. If you're going to start a business, particularly in technology, you're coming to California to do it. Now, once you're a billionaire, and if you're selfish and want to save some taxes and move to Texas and Florida, great, those are homes for you. But if you want to build a company and you want a workforce to do it, this is the state that you do it in. And so I'm bullish. There's there's 20 million people in our target market. We focus on greater Southern California. There's 20 million people in this market. And so if 100,000 left during COVID, who cares?
Yeah.
It doesn't move the needle on it. And to me, it is the supply, it's such a high conviction strategy that we're doing. It's all driven, Taylor, by the way. So, we have this Latin America business that's now entering its 30th year, and which was another, not an easy sell.
That's
it's not on anybody's radar screen.
Yeah.
But we raised 5 big institutional funds there with some huge brand name pension funds and others. And we shifted our business away from bringing U.S. dollar-denominated capital into the region to raising capital from within the region, because the one thing we could never control down there was currency risk. So we might, we were generating 2x multiples at the real estate level. We were delivering everything we said we were going to do, and then we give 80% of that profit back in currency. We could never overcome that. So that writing was on the wall about 10 years ago, and we sat down with our regional heads and we incentivized them to raise capital locally and to be a developer, because we had hired all these development teams because some of our local operating partners had gone out of, global financial crisis hits, all of a sudden 6 of our local operating partners go out of business, and we got a half-built condo project. We have to complete it, which we did without generating any fees.
Wow.
So we had the teams in place, and so by the time we came to Fund 4, this was about 10 plus years ago, I sat down with all of our lead investors. I said, look, we have great teams in place. We've proven our ability to complete these developments. If we hire a land acquisition fee, let us be the developer. We'll still bring in. We're not vertically integrated, so I don't want in-house construction or property management. So we'll hire a local partner. We'll pay him a fee. We won't pay him a promote to be the construction team. And every one of our institutional clients said, love it. We showed why it's a win-win for them. We eliminate a double promote. We get Paladin is now day-to-day hands-on.
Can you explain double promote?
So I mean, a real estate syndicator or sponsor or manager like us, the fees that we earn, the asset management fees, that just keeps the lights on, allows me to keep a staff. Where what we're really trying to do is if our investors make money, then we make money. We share in the profit, and that profit sharing is called a promote or a carried interest. And we for the first 20 years of our Latin America business, we were We would raise money from pension funds, and then we would joint venture with local developers. So we were, and we were a control investor. We were high maintenance capital. We were not passive by any means. And so our local operating partners would earn a promote if the project performed, and then we would earn a promote if that project and the 100 others that we did in a fund performed. Okay, so there were 2 layers of promote. When we shifted to actually being the local operating partner with the blessing of all of our institutional investors, we eliminated a layer of promote. So it doesn't mean the profits go up, but it just it better execution, better alignment of interest. Yes, there was more profit now that would flow directly to our funds, and it's been it actually has proved out to be a win-win. It's been very successful, but that never could overcome the currency.
Yeah.
So we incentivized we started this shift away from being an institutional fund manager in Latin America about 10 years ago, and that is largely successful now. That meant 2 things. Among the many hats that I was wearing in the firm as I was raising all of these funds, I didn't have to get on airplanes anymore and raise these funds, which is great. And then the second thing is Jim and I didn't need to put the lion's share of our net worth in these Latin America funds. And the one thing that was kind of missing from our strategy down there, because it was for sale housing, is it didn't generate any passive income. And so here Jim and I don't know, 5-10 years ago, we're kind of sitting at the same time going, okay, what are we going to do with our time and our money? And what the growing of our, we've always been doing value-added investments, but deciding to really focus on Southern California, this is where Jim and I want to put our money.
Yeah.
And we've been having friends and family co-invest alongside us, but anytime we're doing anything like this, I just like to scale it. So we brought one of our institutional relationships into the last 3 properties that we bought. It's been great. They provided 80% of the capital, and then what I call our friends and family club investors who like to cherry pick deals, they came in for 20%, and that's been phenomenal. And that's our formula going forward, is to replicate that. I've been talking with a number of institutional investors about providing a programmatic sleeve for us for 2025, and I want that to be about 80% of our capital, because where I think this strategy resonates the most, because Jim and I are individuals and it's our own money, and our conservative approach is driven by, I don't want to lose. This is what I'm retiring on.
Yeah.
I've worked really hard to build this up, and I don't want to lose it. And so the downside protection is a huge driver. That resonates with everyone. All of our high net worth and family office investors are in exactly the same boat. Rule number 1, don't lose money.
Yeah.
Rule number 2, don't forget rule number 1.
Yeah.
Right?
Yeah.
Rule number 3, if you can grow my wealth, more power to you.
Yeah. Yeah. So speaking of raising funds, and I think you've obviously done an incredible job of doing that over the past 30 plus years. How do you approach raising money for deals, and what do you think gives you the edge that you have? Because clearly you're very good at it.
Well, when we were starting out 30 years ago, and we didn't have a track record, and we didn't have any institutional credibility, it was just a persistence. I mean, on that Gortner family value chart, rule number 2 or value number 2 that the kids is perseverance, which is just keep moving forward. And so we just kept moving forward. You just block and tackle. It's how do you build any business, right? It's just grit and creativity. It's a lot easier for us now because we've been in business for 30 years. We are a SEC registered investment advisor. We are our quarterly reporting is those templates are used by our largest institutional client, which is the 2nd or 3rd largest pension fund in the country. That is the reporting template for all of their value-added investors. Sorry, buddies, it's our fault, but that's because it's very transparent. Look, we are open book.
Yeah.
And so it's a little easier for us. What I think our challenge is what we talked about, California. There's like some people are scratching their heads, and particularly if we're trying to bring red state capital into a blue state, Fox News completely mischaracterizes California.
Yeah.
I mean, it does. I mean, we've got our faults here, but this is still the best state in the country.
What was is there any stories early on? Like, what was the first time you raised money? I know that you had the family backing from that, but
from
like
Simon,
what was the first, is there any interesting stories about raising money or doing a deal or interesting deal story that you can think of that was like stand out?
Good. There's so many. It's hard to pick because we've done probably 500 assets, $8 billion in real estate, 8 countries. I think the first deal that got us into Latin America is kind of a fun story because, it's around, Jim and I started the business with the Simons in 1995. And our principal investor at that time was the Simon family.
Yeah.
We were creating our track record with their capital and doing very well with that. We had been looking at master plan resorts on the West Coast and on the East Coast, and so we were pretty familiar with that business and done a couple of master plan communities. And a friend of mine put an opportunity in Costa Rica in front of us, and the project level economics were off the charts. We had not done anything in Latin America, and it was one of the largest, most successful master plan resorts in Costa Rica. My partner, Jim, said no at least 2 or 3 times. Finally, and I don't lie, but I kind of tricked him a little bit. I said, hey, come on in. I got some California home builders, which is the truth, in the conference room just to do a quick meet and greet. Comes in, I close the door. We had the whole everything, rendering, plans, all everything you could possibly. The war room was set up on our giant conference room table, and I just said, Jim, sit down for 10 minutes and just listen to this. That was on a Thursday. We were in that conference room for 3 hours. Jim flew down the next day to Costa Rica and toured it. He came back on Monday and sat at that time, Bill Simon Sr., the legendary former Treasury Secretary and leverage buyout pioneer, was chairman of our investment committee. So Jim sits down with him and goes, this is the best deal I've seen in my 30 years from a project level economics. The value proposition here, if we airlifted this to South Florida, it's night and day.
Wow.
And he goes, Bill, I feel so solid about this deal. I will put 100% of the money I'm putting in all our deals today in this one deal. That's how good I go. And Bill Sr. had really distasteful views at the time about Latin America because during his Treasury Secretary days, it was banana republics and juntas and things like that. But it was very different in the 90s. It's not emerging markets anymore. It's kind of emerged.
Yeah.
And so,
what year was this, by the way?
This was 97.
Okay.
So he goes, okay, Jim, you got one of these. So that was the first deal we did. We still own it. And we've already gotten our money back and then some.
Yeah.
But it opened our eyes up to the region. And, it also just says no doesn't always mean no. I wouldn't be married, Taylor, because my wife, when I finally got up the nerve to I made sure that I got into every study group that she was in. So I was a shadow over her.
Number 2.
Exactly.
Right,
persistence. And she actually broke up with me after I had snuck a kiss in somewhere. We drove up to the Bay Area together. And she said, look, you're a nice guy and everything, but I'm in business school and I don't want to get dragged down with a relationship and stuff like that. So she broke up with me at Harris Ranch. A week later, we were madly in love.
Oh my gosh.
And like 3 months later, we were engaged. So no never means no. It usually means not yet.
Yeah.
Our first Latin America fund, I remember the head of real estate at this large pension fund just kept saying, no. And so finally he goes, okay, Gortner, I will throw the spaghetti against the wall and I'll talk about it with my chief investment officer. They ended up becoming the lead investor in that fund, and we hit our maximum within a 6-month fundraise. So Again, no never means no doesn't always mean no.
Yeah.
Not yet. And
In
if you
business,
really
for
do,
sure.
if you really do believe in something and you've got this North Star, go for it.
Yeah.
But you gotta have tenacity and persistence. And my kids hate the word grit, but it's a good word. You just,
I like it.
you and they show it. They have it. They just hate the word. It's like a cliche word.
Yeah, but there's a reason cliches are cliches, because that most of them are true.
It means something,
right?
Absolutely right.
There's value behind it.
Absolutely.
I think it's super interesting to hear that from you, because my experience in the brokerage side of the business too has been one of no means not yet, or and a lot of times, right? We have so much going on, especially in today's world. There's 1,000,001 things we could be doing at any time. We're always connected to our phones.
Yep.
There's always something to do, if you think about it. And so sometimes what we truly want is not necessarily clear to us.
Well, and you also, and in your business, it's huge, because our style is we don't do auctions.
Yeah.
And the only market where you can do that is in a mom and pop market, right? Any market, any real estate market with broad institutional ownership, you have to create an auction process. So why though are you being a good fiduciary to the seller by allowing Paladin to preempt the market and not take it to auction? The reason is our only competition here, our main competition here, are mom and pop exchange buyers, who are a notoriously flaky group. And a lot of times the seller wants to go into a 1031 exchange. And so they need certainty of closing is more important to them than the highest price. And you've seen it where we have been so our value proposition to our stakeholders like you, who are partners in our business. We would not be able to survive without the Taylors of the world, is look, when you get a listing, a pocket listing, before it gets on LoopNet, just give us a 2 to 3 week head start. We'll take the hand scrawled financial statements, just get it, let us walk through it. We'll share our numbers with you. Yeah. You can share them with the seller, and here's our price. And you represent us, so it's a good. There's an economic incentive. But what your pitch is to the seller is, look, I've done a bunch of business with these guys. They've been around for 30 years. When they put something under contract, they close. They don't retrade price. You can't say that about everybody that's in the market. And we've had 4 situations in the last 3. We haven't bought anything in 2 years, but over the last 3 or 4 years, we had 4 situations where we were doing some kind of preliminary preemptive work with folks like you. And then an exchange buyer showed up in the middle of the process and was willing to pay 10 or 20% more, and said, "Good luck to you.
Yeah,
we're not going to compete." And then, lo and behold, 3 or 4 months later, I get a call, and the exchange fell out. Are you guys still good at your price? And our last 4 acquisitions actually was that exact scenario.
Wow.
So. What it means is, when I tell you no,
it
doesn't mean no.
Of course. No, it's so, because this is literally conversations I have every day. I have every single owner, and even if they say they don't want to sell, everything's for sale at a certain price, right? Yeah. Their price might not be realistic, but it's for sale. Yeah. So why do you think that the off-market game, I understand why it's attractive from a buyer's perspective, but why do you think it's still so prevalent when clearly there's a reason that people want to buy deals off market?
Well, I think so much of it comes down to trust. Okay, that's a seller relationship you've been nurturing for years, and you've been doing a ton of work for nothing to help them with estate planning and all kinds of things. Right.
Thank you.
So you're like you're one of their trusted financial advisors. Yeah. It would not happen if there wasn't trust. Yeah. Like, somebody just can't pick up a listing and convince that. So they're trusting you to understand the market and to be able to describe the pros and cons of a particular buyer. And So your reputation is everything, and our reputation is everything, and our reputation with you is everything. I except for one situation where I bought an asset from somebody I don't know these guys. So it's all trust based. It wouldn't happen without that. And we are paying what we think is a fair price, and you're demonstrating that to them, and you're being honest and saying, look, we could list it. And there are people who are, if they're in an exchange, they've got a time deadline, and they're willing to overpay. They're somewhat price insensitive to avoid that tax hit. You might get lucky with an exchange buyer. You might go under contract with them. Their deal might fall out. I mean, there's so many moving pieces. Whereas I've closed a half a dozen deals with Paladin. These guys, I've known Fred forever. I mean, these guys have integrity, and when we go under contract, it'll close. And that reputation and that level of trust is everything. So it could only happen in that environment.
From that, you mentioned briefly you haven't bought anything in 2 years.
Yeah,
why?
It's really frustrating. It's really frustrating because Powell hikes interest rates to make a name for himself in the history books, and all of a sudden my cost of capital's gone up, but it hasn't been reflected in I can't pay as much is what it boils down to. There has to be a pricing adjustment, and there hasn't been any pressure yet on sellers. They're still hoping for that dumb exchange buyer, and that's actually a challenge of this market because it's mom and pop owned. Is that you don't have institutional ownership that is so attuned to, well, of course, cap rates should go up by 50 to 100 basis points. All the sellers that you've been talking to still have 2021 prices in their heads. They're not going to change that unless one thing happens. And, well, they could have estate planning, death, divorce, diaper. There's a lot. The 4 Ds, right? That cause a transaction. But the one that is now, we're at the front end of, I think, a 3-year wave is this wave of commercial debt maturities. Somebody told me that 1 in 5 apartment loans in LA and Orange County over the next 3 years are maturing. So that loan that had been at a 3 or 4% interest rate and cash flow servicing it matures in what is now probably a 5, 6, 7% interest rate environment, depending on the amount of leverage. And it's not, the cash flow is not going to service the debt at the higher interest rate. So you've either got to write a big check to refinance it, a cash in refi, or you sell. A lot of these mom and pops don't have the financial capacity, nor they're just like, oh my God, I got to write a check for $500,000 to refinance, Taylor, really? Yeah. So a lot of them they're going to be forced to bring assets to market. And it's a question for you. I mean, we made an offer on one deal last year after looking at over 200.
Jeez.
And we came close, but we were still $500,000 apart, which was a meaningful amount for us. And we're not going to stretch in this kind of environment. We've got just in the last 2 months, we've put offers in on 6 deals. I had a very good meeting last night. So, I think we're now starting to see some cracks where we've been in this 2-year period of price discovery, and we're waiting for seller capitulation basically to accept the new reality. The new reality is your building isn't worth as much as it used to be. It's the bottom line.
Yeah,
it's just not. And we've come up with some creative ways to overcome that, but I think it really will start to hit next year. I think 2025 will be a good time for people to sell because interest rates are going to be coming down, but it'll be a good time to buy. I think it actually, you'll see normalcy return to the market. There's no normalcy in the market for the last 2 years.
Yeah. You said some creatively. How do you think about creative solutions to make a deal happen?
Well, one of the things that we've done, so a common theme, particularly a lot of the sellers tend to be older folks. So they're either, if a kid, if the next generation inherits the property, they get a step-up basis, great, let's sell it, and we don't have a tax hit. But for an old-timer, older folks that have, they like the income, but they hate the management. Mm-hmm. Their rent control is just another reason for them to want to throw in the towel. But God, I mean, what do I convert this into? And do I buy a triple net property in Skokie or Illinois or whatever? And so what we've done is we've sat down with them and said, look, you've owned this asset for 30 years. You know it, okay? But it's run down, and you've deliberately kept rents well below market. Let us come in. Let us lease it from you. We'll give you the current NOI that you're currently paying. We're going to invest a couple $1 million in your property and enhance it. And we're going to capture that difference between where your NOI is today and where we think we can take it, and give us a few years to actually have some cash flow so that our investors can benefit from that renovation premium. If we default or walk away, you get to benefit from all these improvements. We can't take them with us.
Do you have like a purchase contract in like year 3?
And then yes, then we have an option.
Okay.
And it's somewhere in 3 to 5 years. And sometimes they say, well, what if I find an asset I want to 1031 into? We'll give them a put, but we need enough time to be able. We can't have them put the property to us if we're in the middle of a value-added business plan and half the building's vacant and under construction. And so, but we've come out, we really try to sit down and just say, look, what are your objectives here? What are you really trying to achieve? What would be like the best case scenario? And we try to craft around. But this lease option has been a nice alternative to a 1031. It requires a level of it's a sophisticated idea that requires a sharp broker. Yeah. And also requires, I think, a level of sophistication of the owner to really understand. But we've had that. We've had some owners in the middle of that dialogue say, "Okay, so how much are you putting in?" Well, we're going to put about $2 million into the property. We'll pay. We usually pay them a nice deposit up front. Like, let's say if we're going to buy it for $10 million, we'll pay you $1 million up front now. So let's say I got to raise money for that $1 million. And then I want to put $2 million into it. So let's say that round numbers, that's $3 million. And well, what do you normally give to your investors? And I tell them, we try to, deliver, market rate value added returns to our investors, which are annual returns in sort of the low to mid teens. He goes, well, what if we partner together? And all of that was like a total zinger when one of them had suggested that. It didn't happen, but it was one of those things where it was like, okay, once you actually get to know us and see what we're capable of doing, it's like, okay, these guys actually know how to harness value in an asset that's got potential. Some of them actually want to be our partners longer than just stand off. Yeah. So Jim and I have done probably 200 or 300 joint ventures over 30 years. I mean, there's no boundaries to the creativity that we've done. So when somebody proposes something like that, okay, we'll take a look at it. If we can align our interests, let's do it.
It feels like because I actually had this idea about a year ago. I was like, there's a business in this, right? How many owners have properties that either they don't have the funds to renovate, they want to maximize the value that they've created, right? They don't have the team in place. Right. They don't have all that stuff. Like if there was a company that could go and basically JV this, hey, we're in this together. You're going to provide the real estate. We're going to provide some of the capital and the working and do all the work for you. Yeah. And then either we refinance or sell, and you're going to be able to take part of that upside.
If we sell it, you get the first X million, which is what it's worth today. Yeah. And then we'll split the profit above that. And
I feel like that would be is it the trust that's the hard part to overcome that?
It's totally. The first time this was proposed to us, it only came about because I had met with the seller several times. And I had sent him, look, here's who we are. And we talked about things like integrity and children and school and all that stuff. So it would never happen. It only happened because there was a level of trust and then a level of intrigue of, well, I don't really need the income from this property, actually. And I do make real estate investments with groups that do what you do in Kansas City. So all of a sudden, he went from being a seller to wanting to be a partner.
Yeah.
It was a complete curveball for us, but that's great. I mean, what a great validation of things. So.
If you can be nimble, and it seems like you guys are very creative in your approach because you're willing to look at opportunities from different angles, right? And it speaks actually to your discipline with not buying anything in the last 2 years because there's been a lot of sales in the last 2 years. Not as much as there was previously, but there's still been a lot of activity. So I think for you, it speaks to your ability and Paladin's ability to really stick solid to those values and how you look and approach a deal.
Well, there's two things, Taylor, also that we're going back to your question on what kind of gives us a competitive edge.
Yeah.
We've been in business for 30 years, and I have revenue streams from our Latin America business and so forth, so I don't have any pressure to put money out for fees, which is great. Also, it's my money, so I'm not going to stretch.
Yeah.
I don't want to lose it, right?
Yeah.
That's an enviable position to be in.
Yeah.
And not everybody's in that. So I'm blessed from that standpoint.
We'll wrap it up with kind of a last question, or maybe one or two questions, but looking ahead, what kind of trends do you anticipate are going to shape commercial real estate in the next 5 to 10 years? And again, no one knows, no one has a magic crystal ball, but what do you think is going to shape the way that you do business, I do business, the commercial real estate business is done in general in that 5 to 10 year window?
So AI, as we talked about, for sure. And how that reflects, what comes out of that. There's so many different ways it's going to influence life that it's going to be exciting to kind of watch that unfold. I'm more of an optimist. I've got a lot of concerns about AI and bad actors, and it's going to happen. So hopefully somebody will figure out how to avoid us from blowing up the planet and having the machines take over. We've done every product type over 30 years. I cut my teeth doing Main Street retail, as we talked about when I was in business school. I think that what COVID did was it accelerated and maybe unlocked some of the dynamics that were happening and some of the creative destruction that was happening in real estate that was predating it. So, for example, the Amazon effect on retail, it just accelerated that. I mean, prior to COVID, I did not want to buy anything on Amazon. I wanted to support Main Street retail. I didn't want to enrich Jeff Bezos. But, COVID hits, you had no choice. All of a sudden, Grubhub and Uber Eats and all the, Instacart all pop up. And now I realize, okay, I like the convenience, and I'm actually helping these gig economy workers. So I'm sort of rationalized it a little bit.
Yeah.
But so that's having a real impact on retail. So the whole where retail ends up, it was already heading in a direction of, outlet centers. I don't know how they're going to survive, but experiential retail, like what Caruso tries to do, that should do well. Office, same thing. I remember going to ULI in D.C. Car America was showing off a brand new office building. We're walking through the lobby, and they were describing how they had hired a hotel architect to design the lobby and its amenities. And when you in there, you would think you were in a hotel. There's a deli and bistro, and there's the equivalent of a Starbucks, and there's conference rooms, and there's free fitness centers, and all of these amenities that they had to provide. It felt like a hotel. That's where office is heading, and the whole WeWorks thing. that business model was flawed. Long-term liability, short-term revenues. It wasn't smart. But if you looked at the tenant base of WeWorks, it was all Fortune 500 companies. Mm-hmm. And what were they doing? They're paying a little bit more for rent, but what they're gaining is basically hoteling, month-to-month flexibility. And then you take the whole work from home Zoom phenomenon that's now kind of anchored. I think like a third of the workforce is working from home, which has its pros, but it has its cons. Mm-hmm. You're trying to build teams and instill corporate culture and cultivate, all of the kids that I mentor coming out. It's like, don't work from home. Get yourself in an office. Surround yourself with, get on a team with really talented leaders and just be a fly on the wall and learn how they do it. You cannot do that from Zoom. And so I think those trends are all going to continue. One of the reasons I love, the common theme across everything that we've done at Paladin, we want it to be scalable because we're institutional. It's got to be demand driven. But the key is, our focus on housing, probably 90% of the investments we've made across that $8 billion is low and middle income housing, either for sale or rental. You got to live somewhere. You can't live via Zoom. And so what we're doing here in LA and what we're building down in Latin America, it's an essential need in a supply-constrained market with very little institutional penetration. There's very little institutional penetration in what we're doing here in SoCal, very little down in Latin America. And that's why we like it. We don't like competition, but we bring that institutional competitive advantage and that discipline to this non-institutional space where there is a great market opportunity to provide an essential need. So it will be sold and it will be rented. And the key is, did I get my rents right? Did I get my price right? Did I get my expenses right? And did I get my costs right? Did I get my time right? Those are the factors.
Yeah. And if you can get all those, then, I think you hit it out of the park.
Exactly right.
I appreciate it, Fred.
Taylor, great times.
This is incredible.
Yeah. Always
Thank you.
good talking with you.
Yeah, likewise. Thank you for listening to this episode. If you enjoyed the podcast, it would mean the world to me if you could rate us 5 stars on YouTube, Spotify, and Apple Podcasts. It really helps us get our name out there and helps us get fantastic people like our guests to share their insights and knowledge with you. Again, my name is Taylor Avakian. I specialize in the sale of apartment buildings in Los Angeles and Southern California, and I look forward to sharing more of these conversations with you. See you in the next one.